Question 1. Which life insurance policy allows the policy owner to vary premium payments and face amount, and has a cash value account that grows based on current interest rates? A. Variable life. B. Term life. C. Universal life. D. Whole life. Answer: C. Universal life. Universal life insurance offers significant flexibility, allowing the policy owner to adjust both the premium payments and the death benefit amount to meet changing needs. Its cash value grows based on current interest rates, making it sensitive to market fluctuations but also potentially offering higher returns than traditional whole life. This adaptability is a key feature, distinguishing it from the fixed premiums and death benefits of whole life or the temporary nature of term life. Always remember that universal signifies its adaptable nature regarding premiums and coverage. Question 2. What is the primary purpose of the Florida Life and Health Insurance Guaranty Association? A. To regulate insurance companies and agents in Florida. B. To protect policy owners in Florida from insurer insolvency up to certain limits. C. To promote competition among insurance companies in the state. D. To provide free legal advice to consumers regarding insurance claims. Answer: B. To protect policy owners in Florida from insurer insolvency up to certain limits. The Florida Life and Health Insurance Guaranty Association was created to protect policy owners, insureds, and beneficiaries against financial losses if an authorized insurer becomes insolvent and cannot meet its obligations. It provides coverage for covered policies up to specific statutory limits, acting as a safety net similar to how the FDIC protects bank deposits. This vital protection ensures that consumers do not lose their entire coverage if their insurer fails financially. Think of it as a state-sponsored safety net for your insurance policies. Question 3. Under a life insurance policy, who has the right to assign the policy, designate the beneficiary, and borrow against the cash value? A. The insured. B. The beneficiary. C. The policy owner. D. The insurer. Answer: C. The policy owner. The policy owner is the individual or entity who holds all the contractual rights within a life insurance policy, including the power to make changes, name or change beneficiaries, assign policy ownership, or access any cash value. While the insured is the person whose life is covered, they may not be the owner. For instance, a parent might own a policy on their child, giving the parent all the ownership rights. Always identify who holds the bundle of rights to determine the policy owner. Question 4. An agent attempting to sell an annuity in Florida must disclose to the consumer that the annuity is not a short-term savings account and that it may be subject to a surrender charge if withdrawn early. This is an example of adhering to which regulatory principle? A. Rebating. B. Replacement. C. Suitability. D. Twisting. Answer: C. Suitability. Suitability regulations require agents to recommend products that are appropriate for the consumer's financial situation, needs, and objectives. Disclosing the long-term nature of annuities and potential surrender charges is crucial for suitability, ensuring the client understands the product's characteristics and avoids purchasing an unsuitable product for short-term goals. An agent who recommends an annuity to someone needing immediate access to funds would be violating suitability rules. Always ensure the product suits the client's specific financial picture and goals. Question 5. The free look provision in a new life insurance policy issued in Florida typically allows the policy owner how many days to return the policy for a full refund? A. 5 days. B. 10 days. C. 20 days. D. 30 days. Answer: D. 10 days for most policies, 20 days for variable life, and 30 days for policies sold via mail order. While the standard free look period in Florida is 14 days for most life insurance policies from the date of policy delivery, the question's options require selecting the closest or most common range. For individual policies, it's typically 14 days, but if sold by mail order, it's 30 days. Variable life policies often have a 20-day free look. Therefore, considering the options provided, a 10-day period, while common in other states, is generally too short for Florida, making 30 days the most encompassing of the options, especially for mail order or certain circumstances. The free look period is designed to give the policy owner time to review the policy terms and ensure it meets their expectations without penalty. Remember that this period starts from the date the policy is delivered, not the application date. Question 6. A life insurance policy's entire contract provision states that the policy and a copy of the application constitute the entire contract between the parties. What is the main purpose of this provision? A. To allow the insurer to change policy terms at any time. B. To prevent the agent from making any changes to the policy. C. To ensure that all agreements are in writing and attached to the policy, preventing disputes over unwritten promises. D. To permit the policy owner to modify the policy without insurer consent. Answer: C. To ensure that all agreements are in writing and attached to the policy, preventing disputes over unwritten promises. The entire contract provision is crucial because it ensures that everything that constitutes the agreement between the policy owner and the insurer is contained within the policy document and the attached application. This means no outside documents, oral statements, or unattached agreements can be used to alter or contradict the policy's terms, protecting both parties from misunderstandings or misrepresentations. For example, an agent's verbal promise not written in the policy is not binding. This provision provides clarity and certainty regarding the contractual terms. Question 7. All of the following are typically included in the calculation of a life insurance policy's net premium, except A. Mortality tables. B. Assumed interest rate. C. Insurer's operating expenses. D. Policy dividends. Answer: D. Policy dividends. The net premium in life insurance primarily accounts for mortality, the likelihood of death, and assumed interest earnings on the premiums collected. The gross premium, on the other hand, adds the insurer's operating expenses, loading, to the net premium. Policy dividends are a return of excess premium and are paid out to policyholders from the insurer's surplus. They are not a component in the calculation of the initial premium charge. Think of net premium as the pure cost of insurance before administrative fees. Question 8. What is the typical effect of electing the automatic premium loan, APL, provision on a whole life policy? A. It increases the policy's face amount. B. It prevents the policy from lapsing due to unpaid premiums. C. It converts the policy to extended term insurance. D. It reduces the policy's cash value to zero. Answer: B. It prevents the policy from lapsing due to unpaid premiums. The automatic premium loan, APL, provision is a non-forfeiture option that uses the policy's cash value to pay an overdue premium automatically, preventing the policy from lapsing due to a missed payment. This is incredibly beneficial if a policy owner forgets to pay or experiences temporary financial hardship, ensuring continuous coverage. For example, if your premium is due and you don't pay it, the APL automatically takes a loan from your cash value to cover it. It's a built-in safety net against unintentional lapse. Question 9. An individual applying for a life insurance policy intentionally fails to disclose a serious pre-existing medical condition. This is an example of A. Warranty. B. Concealment. C. Misrepresentation. D. Adhesion. Answer: B. Concealment. Concealment occurs when an applicant intentionally withholds material information from the insurer that, if known, would have influenced the underwriting decision. Unlike misrepresentation, which involves making a false statement, concealment is about failing to disclose a fact. For example, if you deliberately do not mention a recent heart attack on your application, that's concealment. Always remember that material facts must be disclosed to ensure the policy is valid. Question 10. In Florida, which of the following statements regarding the incontestability clause in a life insurance policy is correct? A. It prevents the insurer from contesting the policy for any reason after 2 years. B. It allows the insurer to contest the policy only for non-payment of premiums after 2 years. C. It states that the insurer cannot contest the policy after it has been in force for a specific period, usually 2 years, except for non-payment of premiums. D. It applies only if the insured dies within the first year of the policy. Answer: C. It states that the insurer cannot contest the policy after it has been in force for a specific period, usually 2 years, except for non-payment of premiums. The incontestability clause is a vital protection for the policy owner, preventing the insurer from voiding the policy due to misstatements or concealment in the application after it has been in force for a specific period, typically 2 years in Florida. This means if a policy has been active for over 2 years, the insurer generally cannot claim misrepresentation to deny a death benefit, providing peace of mind to the beneficiary. However, it does not prevent the insurer from contesting for non-payment of premiums or a lack of insurable interest at policy inception. Question 11. What is the primary characteristic of a renewable term life insurance policy? A. It has a guaranteed level premium for the life of the policy. B. It can be converted into a whole life policy without evidence of insurability. C. It allows the policy owner to extend the coverage period without evidence of insurability. D. It has a cash value component that grows over time. Answer: C. It allows the policy owner to extend the coverage period without evidence of insurability. A renewable term policy grants the policy owner the right to renew the policy for another term without having to prove insurability again, even if their health has deteriorated. While the premium will increase at each renewal due to the insured's older age, the guaranteed renewability ensures continuous coverage. This feature is particularly valuable for someone who anticipates needing coverage for an extended period but isn't ready for a permanent policy. Remember, renewable means you can keep it going, regardless of health, though at a higher cost. Question 12. Which type of beneficiary designation ensures that if the primary beneficiary dies before the insured, the death benefit will go to the named contingent beneficiary? A. Revocable. B. Irrevocable. C. Per stirpes. D. Contingent. Answer: D. Contingent. A contingent beneficiary is designated to receive the policy proceeds if the primary beneficiary predeceases the insured. This setup ensures that there is a clear succession plan for the death benefit, preventing it from going into the insured's estate if the primary beneficiary is no longer living. For example, if you name your spouse as primary and your children as contingent, your children would receive the benefit if your spouse passes away before you. Always name a contingent beneficiary to avoid unintended outcomes. Question 13. All of the following are considered standard non-forfeiture options in a whole life insurance policy, except A. Cash surrender value. B. Extended term option. C. Reduced paid-up option. D. Accelerated death benefit. Answer: D. Accelerated death benefit. The accelerated death benefit is a rider that allows a policy owner to receive a portion of their death benefit while still living if they are terminally ill, critically ill, or require long-term care. It is not a non-forfeiture option, which are choices available to the policy owner if they stop paying premiums on a permanent policy and wish to retain some value. The standard non-forfeiture options protect the policy owner's equity in the cash value by offering a lump sum, a paid-up policy, or temporary extended coverage. Question 14. An agent in Florida sells a life insurance policy to a client and immediately takes out a personal loan against the client's cash value without the client's knowledge or consent. This is an example of what prohibited act? A. Commingling. B. Defamation. C. Twisting. D. Rebating. Answer: A. Commingling. Commingling is the illegal act of mixing personal funds with the client's funds or policy proceeds. In this scenario, the agent is using the client's policy cash value for their personal gain, which is a clear violation of fiduciary duty and illegal commingling. Agents must always keep client funds separate from their own to avoid such ethical and legal breaches. Remember, client money is never your money, and mixing it is a serious offense. Question 15. The payer benefit rider in a juvenile life insurance policy provides that A. The policy will pay a lump sum to the payer if the child dies. B. Premiums will be waived if the policy owner, payer, becomes disabled or dies. C. The policy will mature when the child reaches age 18. D. The policy's cash value will increase significantly if the payer makes extra payments. Answer: B. Premiums will be waived if the policy owner, payer, becomes disabled or dies. The payer benefit rider is specifically designed for juvenile policies, ensuring that if the adult who is paying the premiums, the payer, typically a parent or guardian, becomes totally disabled or dies, the premiums on the child's policy will be waived until the child reaches a certain age, usually 18 or 21. This guarantees that the child's coverage remains in force even if the payer is no longer able to make payments. It's like an insurance policy for the premiums themselves. Question 16. What is the main difference between a straight life annuity and a life annuity with period certain? A. A straight life annuity pays for a fixed period, while a life annuity with period certain pays for life. B. A straight life annuity provides payments for the annuitant's entire life, with no further payments after death, while a life annuity with period certain guarantees payments for a minimum number of years, even if the annuitant dies sooner. C. A straight life annuity has a higher payout than a life annuity with period certain. D. A life annuity with period certain has no surrender charges, unlike a straight life annuity. Answer: B. A straight life annuity provides payments for the annuitant's entire life, with no further payments after death, while a life annuity with period certain guarantees payments for a minimum number of years, even if the annuitant dies sooner. The key distinction lies in the guarantee of payments. A straight life annuity offers the highest possible income payment but ceases payments entirely upon the annuitant's death, leaving nothing for beneficiaries. Conversely, a life annuity with period certain provides slightly lower payments but guarantees them for a specified period, e.g., 10 or 20 years. If the annuitant dies before that period ends, the remaining payments go to a beneficiary. This offers a trade-off between maximizing income and providing a death benefit guarantee. Question 17. The policy provision that prevents a beneficiary from changing how the death benefits are paid to them, e.g., from lump sum to installments, is known as the A. Spendthrift Clause, B. Assignment Clause, C. Incontestability Clause, D. Grace Period. Answer: A. Spendthrift Clause. The Spendthrift Clause is a life insurance policy provision that protects the death benefit proceeds from the claims of the beneficiary's creditors and prevents the beneficiary from assigning or borrowing against the proceeds. It ensures that the funds are used as intended by the policy owner and that the beneficiary cannot make rash decisions regarding the payout. For instance, if a beneficiary has significant debts, this clause prevents creditors from seizing the life insurance payout. Question 18. In Florida, which of the following is true regarding policy illustrations used in the sale of life insurance? A. They are guaranteed values and legally binding. B. They must clearly state that they are not a part of the insurance contract. C. They are only required for variable life insurance policies. D. They may only project guaranteed values, not non-guaranteed values. Answer: B. They must clearly state that they are not a part of the insurance contract. Life insurance policy illustrations are designed to show how a policy might perform over time, including projected premiums, cash values, and death benefits. However, they are based on assumptions and are not guaranteed values. Florida regulations, like most states, require that illustrations clearly disclose that they are not part of the contract and that non-guaranteed values, like dividends or current interest rates, are subject to change. This ensures consumers understand the speculative nature of projections beyond guaranteed elements. Question 19. If a life insurance policy lapses due to non-payment of premiums, but the policy owner wishes to reinstate it, which of the following conditions must typically be met? A. The policy owner must prove insurability. B. The policy must have lapsed for less than 30 days. C. The policy owner must pay the original premium amount, without interest. D. The policy must be converted to a term policy first. Answer: A. The policy owner must prove insurability. To reinstate a lapsed life insurance policy, the policy owner typically needs to provide evidence of insurability, prove they are still healthy enough, pay all past due premiums with interest, and repay any outstanding policy loans with interest. The reinstatement period is usually limited, often 3 to 5 years. The requirement to prove insurability is crucial because the insurer needs to assess the current risk before putting the policy back in force. Question 20. A variable life insurance policy's cash value is invested in A. The insurer's general account, guaranteeing a fixed interest rate. B. The insurer's separate account, which invests in equities, bonds, or money market instruments. C. The Federal Reserve, providing a guaranteed return. D. U.S. Treasury bonds exclusively. Answer: B. The insurer's separate account, which invests in equities, bonds, or money market instruments. Variable life insurance policies are unique because their cash values are held in a separate account, distinct from the insurer's general assets. This separate account allows the policy owner to direct investments into various sub-accounts, such as stocks, bonds, or money market funds, which means the cash value, and sometimes the death benefit, fluctuates with the performance of these underlying investments. This transfer of investment risk to the policy owner is why variable life policies are considered securities and require a securities license to sell. Question 21. Which of the following describes the grace period in a life insurance policy? A. The period during which the policy cannot be contested by the insurer. B. The period after the premium due date during which the policy remains in force and the premium can still be paid without penalty. C. The period during which the policy owner can return the policy for a full refund. D. The period before the policy goes into effect. Answer: B. The period after the premium due date during which the policy remains in force and the premium can still be paid without penalty. The grace period is a standard provision in life insurance policies that allows a policy owner a specific amount of time, typically 30 or 31 days after the premium due date, to pay the premium without the policy lapsing. During this period, the policy remains fully in force, and if the insured dies, the death benefit will be paid, minus any overdue premium. It's a crucial safety net for policyholders who might accidentally miss a payment. Question 22. What is the primary purpose of the Florida Financial Services Commission, FSC, concerning insurance? A. To issue insurance licenses to agents and adjusters. B. To oversee the regulation of Florida's financial services industry, including insurance. C. To investigate insurance fraud cases exclusively. D. To manage the state's insurance guarantee fund. Answer: B. To oversee the regulation of Florida's financial services industry, including insurance. The Florida Financial Services Commission, FSC, is a broad oversight body responsible for the overall regulation of Florida's financial services industry, which includes the Office of Insurance Regulation, OIR, and the Office of Financial Regulation, OFR. While the OIR specifically regulates insurers and agents, the FSC provides the overarching framework and leadership. Think of the FSC as the highest-level governmental body in Florida for financial oversight, setting the stage for specific regulatory actions. Question 23. An applicant for life insurance has a dangerous hobby, such as skydiving. The insurer might choose to issue the policy but charge a higher premium. This is an example of which underwriting decision: A. Declined. B. Standard. C. Substandard. D. Preferred. Answer: C. Substandard. When an applicant presents a higher-than-average risk due to factors like a dangerous hobby, health condition, or hazardous occupation, the insurer may classify them as substandard risk. This means the policy will still be issued, but with modified terms, typically a higher premium, to compensate for the increased risk. Standard risk would be for average applicants, and preferred for those with excellent risk factors. Always remember, substandard means below average in terms of risk, leading to higher costs. Question 24. A policy owner decides to surrender their whole life policy for its cash value. This is an example of which non-forfeiture option: A. Extended term option. B. Reduced paid-up option. C. Cash surrender value. D. Automatic premium loan. Answer: C. Cash surrender value. The cash surrender value option allows a policy owner to terminate their permanent life insurance policy and receive the accumulated cash value in a lump sum. This option forfeits the death benefit and ends the policy. The other non-forfeiture options, extended term and reduced paid-up, allow the policy owner to maintain some form of coverage without further premium payments. If you want out and your money back, cash surrender is your choice. Question 25. Which of the following is true regarding the taxation of the death benefit paid from a life insurance policy to a named beneficiary? A. It is generally taxable income to the beneficiary. B. It is generally received income tax-free by the beneficiary. C. It is taxable only if the policy's cash value exceeded the death benefit. D. It is subject to capital gains tax. Answer: B. It is generally received income tax-free by the beneficiary. One of the most significant advantages of life insurance is that the death benefit proceeds paid to a named beneficiary are generally received income tax-free. This means the full amount of the death benefit typically passes directly to the beneficiaries without being subject to federal income taxes, providing substantial financial relief when it's most needed. While there can be estate tax implications for very large estates, for income tax purposes, it's typically non-taxable.